going on, everybody? Ronald here. Today we're going to be discussing the interest on a loan and if you can deduct it on business income. Let's go. So, when you get a mortgage, for example, for a rental property, the interest that is on that mortgage, you are allowed to write that off for, against the rental income. So, for example, if you were to maybe even take out a home equity line of credit to increase the value of the rental property, in the future you can charge a higher rent because it's a higher quality um, building. Then, basically you're borrowing money to make more money, and that interest is deductible. Some people might be asking me, oh, these days with interest rates so high, is it better to pay off some of the mortgage? Well, if it's your principal residence, you can't write off that interest anyways because that is not a loan that is used to make money. It's a loan that is used to uh, for housing for your principal residence. So if it's a principal residence, yeah, maybe if you have extra money and you don't have any other good investment opportunities, it might make sense to make some extra payments towards your mortgage, depending on if there's any prepayment penalties. However, if it's a rental property, it might be better that if you don't pay off your mortgage, so you can write off more of that rental income, so you pay less rental income tax at the end of the year. So um, it depends, if you is your tax-free saving account full, is your RSP full, um, are those registered accounts full? It's good to make use of those. And I would say if you have a rental property, it's generally better to just not pay off that mortgage so you have more to write off. So your tax bill in April will be less. So you can also cash out refinance, like I said, to improve the property. However, if you use that loan for investments, such as renovating the property, you can turn it into a tax deductible expense. Okay? So there's something called a Smith maneuver. So you borrow money to invest in capital property that generates income. For this, you can ask your accountant to confirm. The best would be to just uh, the most clear way for sure that you can write it off is a mortgage interest that is on that property. But if you were to buy another rental property or to buy stocks, then I think most likely you can still write it off, but you just need to confirm. However, let's take a look at this article here. Capital gains is not considered income. So if you borrow money to generate capital gains, it's not tax deductible. So what you should do is buy stocks. If you were to get a home equity line of credit or any other loan to invest in stocks, um, to get dividends, okay? Receive dividends here. So, but just make sure one thing, the concept of leverage, make sure your interest rate on your loan is not going to be higher than your expected rate of return. Otherwise, you're going to lose money. So if you do take out let's say you already own one property or a primary residence and you want to invest in an investment property, you can use a HELOC. And HELOCs are usually pretty low interest because it's a secured loan with your home as a collateral. And you can use it as a down payment for investment property. And yeah, because the loan is going to be tax deductible. Okay. Here's another scenario. If you have a rental property and not a principal residence yet, and you use a HELOC to buy a principal residence, that interest on that loan will not be deductible because the purpose of the loan is to get a primary residence and it is not used to earn income. Therefore, the interest borrowed on the money, which is to acquire the primary residence, is not tax deductible. And if you borrow money from HELOC to invest in registered accounts, the interest is also not tax deductible because registered accounts are already tax exempt. However, interest on money borrowed to invest and earn taxable income is deductible. But the other way around is if you take a HELOC on your principal residence or another rental property to buy another rental property, then the tax deductions can be done. So before you make any big moves, such as paying off um, mortgage on a rental property or taking out a HELOC to do anything, just make sure you talk to your accountant and make sure that try to make that interest tax deductible because it's a lot of savings that you don't want to miss out on. Because rental income can be quite a bit, can be maybe say 30,000 a year easily, and if you can write off all the interest, you end up paying a lot less income tax. Great. So I hope everyone enjoyed the video today. If you have any questions, please call me or email me. I'll be happy to help. Take care, everybody. See you next time.